Today is Monday, 2nd of June 2025, 6 a.m. Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. The trading day unfolded with a diverse set of influences shaping market dynamics, as investors balanced a range of factors from robust sector performances to cautionary global signals. The technology sector emerged as a decisive leader, with several notable players driving gains. This rise underscores the sector's continued resilience and innovation, which remains a compelling narrative in the investment landscape. The sustained appetite for tech equities is supported by advancements in artificial intelligence and ongoing digital transformation trends, which are providing fertile ground for growth. Meanwhile, broader market indices exhibited a cautiously optimistic tone. The sentiment was buoyed by recent economic data, indicating a stronger than expected performance in key economic indicators, which has offered a degree of assurance to investors. However, this optimism was tempered by prevailing geopolitical uncertainties, which continue to cast a shadow over market confidence. These geopolitical tensions, ranging from regional conflicts to policy shifts in major economies, are contributing to a sense of unpredictability that market participants are keenly monitoring. In the commodities space, movements were influenced by these global cues, with oil and precious metals reacting to shifts in geopolitical landscapes and supply chain considerations. Currency markets mirrored this complexity, as fluctuations were driven by macroeconomic announcements and central bank policy deliberations. The interplay between these market components highlights the intricate dance between local economic strength and global political contexts. As we progress through the financial calendar, the interplay of these dynamics will remain a pivotal focus for both institutional and retail investors. The coming weeks will likely test the resilience of the current market momentum, as stakeholders continue to navigate the evolving landscape. This delicate balance of optimism and caution is emblematic of the current economic climate, where opportunities are closely intertwined with risks. The landscape of global financial markets today reflects a mixed performance across major indices. In the United States, the S&P 500 edged slightly lower, indicating a minute decline in broad market sentiment. The Nasdaq Composite, however, faced a more pronounced drop, suggesting a notable pullback in the technology sector, which has been highly sensitive to broader economic conditions and interest rate movements. Meanwhile, the Dow Jones Industrial Average bucked the trend with a modest gain, driven by strength in industrial and financial stocks, sectors that have shown resilience amidst economic uncertainties. The Russell 2000, which tracks smaller cap companies, experienced a steeper decline. This index is often viewed as a barometer of domestic economic health, and its performance today underscores the challenges facing smaller firms, potentially due to tighter credit conditions or economic slowdown fears. Volatility, as measured by the CBOE Volatility Index, surged significantly, reflecting heightened investor anxiety and potential market turbulence. This increase often signals investor unease and a flight to safer assets, possibly driven by geopolitical tensions or macroeconomic data releases. Elsewhere, in Europe, the FTSE 100 and Germany's DAX both posted declines, with the latter experiencing a sharper fall. These moves may be attributed to concerns over economic growth in the Eurozone, inflationary pressures, or currency fluctuations affecting export-oriented companies. In Asia, the Nikkei 225 registered a significant loss, continuing a trend of volatility in Japanese markets, potentially influenced by fluctuations in the yen and external trade pressures. The Hang Seng Index in Hong Kong and the Shanghai Composite both retreated as well, reflecting broader concerns in the region, possibly linked to regulatory developments or economic data out of China. Overall, today's performance across these indices highlights a cautious investment climate as market participants navigate a complex array of economic signals and geopolitical events. In the current landscape, bond yields reflect a dynamic interplay between investor sentiment and macroeconomic indicators. The 10-year Treasury yield, a crucial benchmark for gauging market expectations, has edged lower to 4.416, marking a slight decrease of approximately 0.18%. This movement suggests a potential shift in investor appetite, possibly driven by recent economic data or monetary policy signals that may have tempered inflation concerns or increased demand for safer assets. Conversely, the 13-week Treasury bill yield has nudged upwards to 4.232, albeit with a modest increase of around 0.05%. This upward adjustment might indicate that investors are seeking returns in shorter duration securities, possibly due to expectations of fluctuating interest rates or a cautious outlook on longer-term economic stability. Such a trend often reflects a defensive positioning, where market participants prefer the relative safety and liquidity of short-term instruments amid uncertain times. Meanwhile, the 30-year Treasury bond yield has risen to 4.929, with an increase of about 0.12%. The upward trajectory in longer-term yields could be interpreted as a response to expectations of sustained economic growth or longer-term inflationary pressures, prompting investors to demand higher returns for locking in their money over extended periods. This increase might also reflect a recalibration of risk assessments as market participants weigh potential fiscal policies and their implications on future economic conditions. The current spread between short-term and long-term yields offers insights into market sentiment and economic forecasts. A narrowing or inversion of this spread could signal concerns over economic slowdown or a shift in monetary policy expectations. As such, these yield movements are critical for investors and policymakers alike, providing valuable clues about the market's outlook on growth, inflation, and interest rates. The nuanced shifts in these yields underscore the complexity and interconnectedness of global financial markets.